In this video, we'll be discussing the differences between an IRS lien and an IRS levy. An IRS lien is a measure taken by the IRS to protect the value of the debt it believes it is owed. The government doesn't actually take anything from the taxpayer just by virtue of the fact that an IRS tax lien has been filed. Instead, an IRS tax lien just secures its place and indicates a willingness of the government to take action against the value of the taxpayer's property to force the taxpayer to pay the IRS lien. The IRS lien is created immediately when the taxes have been assessed, even if the IRS tax lien is not filed, published, recorded, or in the public record. An IRS may file a federal tax lien even when the taxpayer thinks collection activities have stopped. For example, even if the taxpayer is on a payment plan, the IRS may send Letter 3172 and file a lien just to protect its interest in case the taxpayer should ever fail to make agreed-to payments. The IRS lien applies to everything the taxpayer owns after the tax lien is filed, and anything the taxpayer acquires after the tax lien has been filed and recorded. But the IRS may release its lien for a few reasons. The most common reason for the IRS to release a tax lien is after payment has been made on taxes and penalties owed to the IRS. The IRS may discharge its lien on a particular piece of property to allow the taxpayer to sell that property if the IRS believes it will help the taxpayer be more likely to pay off their IRS debt. The IRS may also allow their lien to be subordinated, which means lower their place in the payback line if the IRS tax lawyer can convince the IRS that it is in their best interest. An example of this is with real estate. Perhaps the taxpayer might be able to get a mortgage on the property and use the proceeds of that mortgage to pay off the tax lien. The IRS may agree to this sort of a deal if all or a significant portion of the newly borrowed money is going to go to them. The IRS then can withdraw their federal tax lien, which eliminates all filings and is the only way to erase it from the taxpayer's credit record. If the taxpayer qualifies for IRS lien withdrawal, the IRS will actually send the notice of withdrawal to the three main credit bureaus. But a lien typically won't be filed until it reaches at least $10,000. After the taxpayer starts a direct debit payment installment agreement and the lien is less than $25,000, the taxpayer will be able to request a withdrawal of notice of federal tax lien if the direct debit installment agreement provides for payment in full within 60 months or when the IRS statute of limitations expires if earlier and the taxpayer has made at least 3 months worth of payments on the IRS installment agreement. On the other hand, the IRS levy is a much more serious effort by the IRS because unlike the recording of an IRS tax lien, an IRS levy or seizure is when the IRS actually takes something from the taxpayer. This is usually in the form of taking real estate, other property, or garnishing their wages. An IRS levy typically refers to cash, right? They're taking money from your investment account or garnishing the taxpayer's wages. An IRS seizure, on the other hand, is a type of levy that typically refers to when the IRS takes something tangible, for example, a car or a piece of real estate. Let's talk a little bit more about an IRS wage garnishment. The IRS can levy against a taxpayer's wages by sending a letter to the taxpayer's employer and directing them to take a certain amount out of the taxpayer's paycheck for each pay period until the federal tax lien is satisfied. The IRS wage levy is also called a continuous levy because the wages will continuously be garnished per pay period until the IRS lien is fully satisfied. The continuous levy is different to the IRS levy of a bank account or the IRS levy of an investment account, which are one-time levies in that they're not continuous. How does the IRS levy a bank or brokerage account? When the bank or other financial institution receives an IRS levy notice, only the amount in the financial account on the date the notice is received is subject to the IRS levy. So if a brokerage house receives a notice of IRS levy on January 1st and a deposit is made on January 2nd, only the amount in the account on January 1st and earlier is subject to being levied. Once receiving the IRS levy, the bank will hold the amount levied for 21 days. If the taxpayer has not done anything to get the IRS levy released within that 21-day period, the financial institution will transfer the amount being held to the IRS. Practically speaking, what frequently happens is that bank policy, which is not IRS law, will freeze the entire account until the IRS tax levy is dealt with. If the IRS levy amount is substantially less than the value of the account, your tax attorney may ask the bank to release the levy amount to the IRS prior to the 21-day period so that you can access subsequently obtained funds. Now let's discuss how to file an appeal after the IRS has commenced levying efforts. Generally, filing for an appeals hearing will stop the IRS's levy efforts, which is also referred to as an equivalency hearing, if it's filed within 1 year of the date of the 1058 IRS intent to levy letter is received. The only difference, and the reason why you want to get your tax lawyer involved, is that the taxpayer has no right to appeal the results of an equivalency hearing to tax court, the way your tax lawyer can if you appeal within 30 days after receiving the 1058 letter. This is exactly why whenever you get a letter from the IRS, you want to get a qualified tax attorney involved as soon as possible.